So another company that we're reviewing today from one of our viewers, which is great. And I'm loving these companies now. So this company today is EQTEC, very similar in some ways to Powerhouse Energy, in the same category. Omar sent this request in to us, and we're happy to do so. This company is very similar to Powerhouse Energy, as I said. Basically, what they do is they take a bunch of waste and through their technology, they convert it into synthetic gas. And that synthetic gas is used as fuel for application in terms of heat and energy. And the application could be in cars, households, whatever it might be. But it's exactly clean energy technology. So we found something really interesting around their finances. Great company to look at in the green energy space. Ted, let's share with our viewers what we found.
Excellent. Well, good to hear from you, Moeed. Hope you are well. So, as you said, let's dive straight into their financial statements. So here are the financial statements. They are available on their website and they are available to download. So what we're going to do is start off by looking at the income statement as ever. So we'll just whiz down to the income statement, which is on page 18 of their accounts. So we're looking at the left-hand column, Moeed, which is 2019. So this is the latest set of numbers up to the 31st of December 2019. It jumps out very quickly. Their revenue and their cost of sales are almost exactly the same. So they are making a profit, a gross profit. This is their trading account. It's a little bit better than last year when they were actually trading at a negative, at a gross loss of 4%. So they are profitable, but they're not really very profitable. And the problem here for these guys is that they're making a profit, but the costs of running the business, the administrative expenses, that's the sales, general and admin, things like HR, finance, light, rent, rate, heat, directors' salaries, all that kind of stuff that every business has to incur. £2.7 million means that they're booking an operating loss down the bottom here. So their overall loss for the year, £3.6 million, a little bit better than the previous year of £8.2 million. Now, there's a few little funnies going on at the moment here. And what you can see, if I just clear these drawings, is what's going on here. So there's some strange numbers coming through. Certainly in 2018, they've got the reversal of impairment of impairment or impairment of property. So in last year's accounts, they impaired their property by £2.1 million, and they had impairment of goodwill of £1.4 million. Now you add those two together, you get about £3.5 million of impairment. Now, goodwill is the difference, it arises on acquisition, is the difference between what you pay for a company and the value of those assets. So when you buy a company, you buy the assets, you buy the liabilities. Effectively, you're buying the net assets, or the NAV as it's known. And the more you pay compared to that NAV, that's treated as goodwill in the balance sheet. So writing down that goodwill says you kind of overpaid. It's not worth that much. So you've got a write down of goodwill, you've got a write down of property and equipment and intangible assets as well. And then what you notice here is that there's a write back of some of that impairment. So they kind of say, well, we've written it down, and then this year they're saying, oh, we wrote it down by too much, we're actually going to increase its value. So these numbers here kind of suggest, you know, there's something a little bit funny going on. Often you find that the numbers on the right is like a kitchen sink moment where, you know, there's a little bit of bad news and we just chuck all the bad news in there. So if we're going to make a loss, let's make a massive loss, and then we can return to profitability, for example. So, you know, that's kind of what I think is happening in 2018. And then we see in 2019, not only is there a little write back, but then there is this impairment of inventories, writing down of inventories. And it's interesting that these two numbers are about the same. So it looks to me maybe that they're writing down their inventories, but they're trying to offset it by writing back some of the property, plant and equipment impairment. and they're trying to kind of minimize that loss, and again, this is kind of buying into the story that they're trying to sell of a loss of 8.2 million, a loss of 3.5 million. We're going to be profitable going forward. So it'd be interesting to see what their next set of accounts look like when they actually produce them. So there's our profit and loss account. If we look at the balance sheet, look at the strength of the company, here are the total assets. So 17.8 million up at the top, and the biggest is the intangible asset. So this will be in the investment in the technology that they've been developing for their for this kind of this recycling effectively. There's no inventories, so the inventories have been effectively written off completely. So last year, so there's the inventories. They've written those down to sort of zero, and that was the charge that we saw in the accounts. These are the intangible assets. They've got some financial assets as well, and the property, plant, and equipment has been written right down from 2.3 million down to very little indeed. They got some cash sitting here as well, about 482,000. So that's the asset side of their balance sheet. Looking at the liabilities side, what we can see so we look at the current liabilities down the bottom here. They've got some borrowings in there. So current liability of borrowings. There's no non-current liability borrowings, which means that they're effectively being financed through short-term debt. Now, short-term debt is repayable on demand. So they kind of need to make sure that, if the bank manager comes and says, I want my money back, they can afford it. Well, they can't, because they've only got 2.4 million of current assets, and they've only got about 400,000 in the bank. So this is kind of, this is quite high risk. This is what's known as the working capital, current assets to current liabilities. The current liabilities are 3.5 million, and the current assets are only 2.4 million. So there's a few risks coming in there. The other thing we notice from the balance sheet is, and I'll scroll back up again, let me just clear those drawings, is the equity. And the equity, we see that this company is very much funded through investment by the shareholders. You'll notice that that investment has gone up, which means that they have raised money during the year, and they've been losing money. So effectively, they've raised whatever that is, 7 million euros, and they've lost so far 56 million. So a lot of investment, and that's that's absolutely fine. There's a lot of investment. You're going to make a loss before you make a profit. The question is, are they actually going to finally make that profit? They've got some debt sitting there. They haven't got the cash to pay off the debt. Are they going to have to tap up the shareholders yet again in order to survive, or have they managed to close some deals, come to profitability, generate the income, etc., etc.? Okay, now again, we don't know that, Moeed. We're not that close to the business, so if there are people who are watching this who have some insight as to deals which have been signed, then that's useful, and do add it to the comments. So here is the cash flow. Always useful to look at the cash flow, and the key number we are really interested in is this number here. So this is the cash used in operating activities. So their cash burn rate is very similar to their loss, effectively, and effectively there's no big movements going on there. There's a little bit of a few movements in terms of their working capital, but they're burning at £3.5 million a year. They've got 400,000 in the bank. It's not looking too good. But again, they're still out there. They're still trading. So maybe they've raised some more money. Maybe they've managed to sign some deals. If we look in the bottom half of the cash flow, here we can see the top line up here. So the proceeds. So you'll see here the proceeds and the repayment of borrowings. So they have been they have been and the loan issue costs. So they have been borrowing, and that's sitting on the balance sheet. And then we see here, you can see the proceeds from the issue of ordinary shares. Here they are funding through equity, so an extra 3.5 million. So they've raised 3.5 million through equity. Some of that they've used to pay down their debt. You can see here that in 2018, just highlight these two numbers. In 2018, they borrowed 6 million. They repaid 2.6 million. So effectively, their borrowings increased by 3.5 million. It's too much, and they needed to pay that down. So they raised 3.5 million in 2019, used 1 million of that to pay down debt, and the rest they've been using to run the business, you know, the operational side of the business. So that's, you know, those are the kind of, the key numbers. They've got negative cash flow. They're making a loss. The balance sheet isn't overly strong. They don't have tons of cash in the bank. So if we go to page 15, we will see the director's report, and it's worth always just looking for, and we see this a lot, Moeed, over these energy companies which are making losses, this going concern. So here we see the comment on the going concern, this paragraph towards the bottom here, that talks about how the directors feel confident that they are a going concern and that they will to continue to trade, but they're just flagging it. So let's look at the auditor's report. Now, the auditor's report by Grant Thornton is actually tucked down on page 67. So usually you'd see the audit report would be just before the financial statements. We get the audit report and then we have the financial statements. But these guys, they put it right at the end of the financial statements. And sometimes that makes me a little bit nervous, because it's like, well, why would you want to put it so far down? Why don't you want to sort of bring it up and show, look, I've got a clean audit report? So the opinion of the auditors, Grant Thornton, is that, it's all fine, but they do give a couple of identifiers or flags. The first one is the going concern. And they say that, their opinion is not modified, but they do draw the concern of the directors to this going concern. So the directors have said, look, you just need to be aware that, we're confident, but, things are tight, life is difficult, which is drawn out in the statements, and the auditors are basically saying, and we want you to kind of be very, very aware that the directors have shown this. So everybody's trying to be as upfront as possible that, there are risks associated with this company. And then we're not just talking about the market risks of does the product work type of thing, can they get the clients on, but also, the actual financial risks associated with running the company. They also give an emphasis of matter, which is on the impairment of goodwill. So if you remember, we looked at this goodwill, the big write-off in the previous year, for example, and the auditors talk about how they've considered the adequacy of the disclosure of the notes, and how the directors have to make their own kind of judgments and decisions, and they say, as part of our audit, we've gained sufficient audit evidence supporting the assumptions of the model. However, in view of uncertainty in relation to the future event that affect the timing of revenue, cash flows, and significance of this balance and the consolidated, we consider it should be drawn to your attention. So they're just saying, look, this is a big number, and we pulled it out, we looked at it, we highlighted it, and the auditors have said you just need to be aware that this is a very difficult number to put your finger on. We just don't know what is, we have a way of calculating goodwill, but I'm not sure that it's kind of like, it's not very scientific, so to speak. So those are really kind of the key things that we want to pull out from this company. So let's go back and look at the market value of the company. So this is a couple of days out of date, but not too far. So we see that this company has a market cap of 126 million euros. So 126 based on a balance sheet of about 15 million. So it's pretty much all goodwill in there. You can see the share price has been bouncing around downwards since the 1st of November 2008, and has effectively just been flatlining, it suggests here. Obviously there's no PE ratio because it's negative. So is it a buy? You know what, I don't know the industry well enough. If I've been watching the news, if I've been kind of following this company on a day-to-day basis and watching the updates and seeing how it's progressing, then I may be tempted to, if I knew something that somebody else didn't, without obviously getting into insider dealing. So you have to only be dealing on market knowledge. So if your friend works there and knows there's a big pipeline, then that is actually illegal to operate on that kind of information. But it seems quite expensive for a company that is making a loss. But who knows? Maybe that it will come good. Maybe this is the one to back.
Yeah, it's similar story to a couple of other clean technology businesses that we've looked at in the past that our viewers have requested. So interesting to see what our viewers have to say. You know, if there's anyone that's an expert in this industry, we'd love to hear from you and what you have to share for the rest of the community. So leave a comment in the comment section. As usual, like, share, subscribe. And look, if you want us to have a look at a company that you're interested in, whether you're investing in them, whether you're thinking about doing business with them, or even if you're going to have an interview with them and you want to work with them, leave a comment. Tell us about the business. We will analyze it for you so that you can make better informed decisions, have better presentations, and sound smarter during your interviews. So Ted, thank you again, and we'll wait until the next video and we'll see you all there. Thank you.